Hey everyone, what a day it was again. We ended the week last week on a fairly sour note. We had a big blowout in VIX on Friday, and the volatility futures rose. But then VIX kind of compressed into the end of the day as people sort of monetized their protection, right? Any hedges they had on, they started to sell out, and people started to look at that high volatility as reason to start generating premium again, right? Generating some income strategies, selling put spreads, things like that. So people taking advantage of that, and of course not knowing that Monday was going to be our sort of mini Black Monday. So let's take a look at what happened today. Things definitely got a little uglier. Here we've got the S&P 500 market cap weight, so the SPY that we know and love. We had that high a few weeks ago, maybe about a month ago, not even really. And we pulled back. Of course, you can see I love to watch that 9 EMA. We've got bounces all the way through here, a little breach, another bounce along there, all the way up to these highs. Very, very distant from the 50-day, which of course people were starting to talk about in the news, how far we were from that 50-day. And we had extremely low volatility. If you recall, we had about a 6.5 10-day historical volatility. That's extremely low. We got to the point where markets were barely moving again. And perhaps a sign that that can't last forever. I tweeted it out at one point saying this is not normal, this is not healthy, and something bad might happen. So here we are, we finally start to give way. Of course, semiconductors really leading the way. A couple of the generals, NVIDIA, Microsoft finally giving it up. NVIDIA was really the one to kind of start to crack first. And let's take a quick look at NVIDIA here. As those semiconductors started to crater, we had a nice delta here, but then after that we started to breach. As soon as we breached that 50-day, we saw that things started to get a little bit more urgent, a little bit of a retest here. Remember, NVIDIA got almost up to 123-ish that day, and then the bottom just fell right out after that. Take a look at the SPY again. Friday, Monday, horrible open, and but not as bad as the NASDAQ. Let's take a look at the NASDAQ here. Very big down open. So we opened at 425-ish. I believe we were just a slight bit lower. At one point we were well over 6% lower in the pre-market. And we managed to rally almost closing this gap right here. A pretty impressive rally actually in the end. And we had the VIX do something it has never done before. So up until today, the most the VIX has ever risen in a day was about 124.5%. We saw that back in an event called the Volmageddon back in 2018. Really ugly day where the VIX more than doubled as too many people on one side of the boat of the short volatility trade tipped the boat right over. And so we had a number of products actually blow up. If you recall, XIV was a product back then that was short volatility. It had been a real favorite amongst the short vol traders, and it disappeared. It was gonzo. And so since then, we have not actually seen as big AUM sort of gather in that space. After that blew up, we're not nearly as big as we were back then. So something else is going on here, guys. This is very unusual for the VIX to go up 150% in a day, especially with the S&P 500 only down about 4.5. And I say only, not that that's not a big amount. We do not want to see our stocks go down like that. But relative to the move in VIX, this was not that much. And so what that is really called a dislocation. This is a dislocation as volatility products have become assets of their own, things that people trade to generate alpha and yield and et cetera. Volatility should connect the market, right? Markets move, and as they get more volatile, you see the VIX rise. And there's a link there that should be fairly strong. What we've seen today is an example of when that link can completely break. The clamp braked and the VIX effectively decoupled from the market. Why is that happening? Well, there's been talk of the Japanese yen carry trade, and so people have been effectively, the way that the trade works is people have been borrowing at extremely low Japanese rates because they've been kept down. And they're going out around the world and doing all kinds of stuff. You can borrow at zero almost and invest in U.S. Treasuries. You can invest in, most certainly, you can invest in NVIDIA and all the Mag 7, 8, 9, 10 stocks that have been doing very, very well. So there's no question that has been a trade. Borrow for nothing and buy everything else in the world. And as soon as Japan raised interest rates, this was under threat. Not only were traders who had the carry trade on getting a little bit hurt on that rate hike, but also in the currency. Right, the Japanese yen has been rallying, and that has hurt them from an FX perspective. So it doesn't seem like much, but remember, markets are often subject to changes at the margin. Things sometimes just need to change just a little bit, and things can snap and break, especially when it's a trade that, by some estimates, has between $4 and $20 trillion in it. And so this is not small potatoes, guys. This is something that we are perhaps seeing manifest itself in the volatility markets, because no one's come out. It certainly seems like some funds have blown up. It certainly seems like somebody's in trouble. This just does not happen without something going on. Now, I don't know if you can go as far as to say that there's something going on with the plumbing of the financial system. I hesitate to say something like that, because then that takes us back to the global financial crisis, where there was some systemic questions, some risk, some potential for the system actually breaking down. So we're far from saying something like that. But a VIX that goes from 12 to 65 in the span of a few weeks is a sign that something very, very serious is going on. Now, what we did see, why don't we take a look at our trusty VIX futures curve here. Something very fearful is going on here. So we've got our VIX futures well below the VIX cash. So the green line here is your VIX cash, which is, you know it as the VIX. Whatever they report on TV is the VIX cash, essentially. The VIX futures, though, are the things that we're actually trading more. We can't trade the VIX per se. You can trade options on the S&P 500 and approximate something that looks like VIX, but VIX is extremely hard to replicate. What you can trade is VIX futures and volatility products that we know, like VXX, UVXY. These are products that are based on the VIX futures. They are not based on the VIX. So that's first and foremost, that's what you need to know. So we're looking at a curve that is actually quite fearful. We've got the front part of the curve is called backwardation. We've got the front part higher than the second month, and it's actually higher than the third, fourth, and fifth month. So we've got steadily upward sloping as we go towards the front of the curve. That is very, very fearful. It's not all out panic yet, but it is very, very fearful. And so I think something is going on out there. We don't know what it is. We don't know how bad it is. We don't know how big it is. We don't know exactly what's going on. We don't know what's unfolding, unwinding. Is it hedge funds blowing up? It's certainly more than the Friday jobs number. It's certainly more than the worry that interest rates are going to come down. It's certainly more than one specific data point. There is something going on out there that is not fully understood at this point. The yen carry trade, absolutely. This could be a big part of it. By some measures, it is said to be between $4 and $20 trillion in this carry trade, which is basically people going and borrowing at exceptionally low interest rates in Japan and using that to invest everywhere else and lever up everywhere else. Buy the Mag 7, buy treasuries, buy anything that can yield you more than 0%. So this has been a very, very big trade for people, and they have been doing very, very well in it. Now they're getting hurt. You've got interest rates in Japan that have only gone up a tiny little bit, but you've got a yen that's very strong. These people are getting hit from a couple of different directions, and it's said that this is part of what the unwind is that's happening out there. Now, I've been scouring my sources, this and that. Nobody can quite put their finger on the pulse. But we saw a VIX cash of 65 today. 65. That is exceptionally high for a 4.5% S&P drop. That is a sign of decoupling. This happens every now and then, a decoupling of the volatility markets from underlying reality. Because the reality is, options should be kind of connected to underlying risk. A VIX of 16 means the S&P 500 is moving about 1% a day for the next 30 days. So there's some connection there. We can't just completely decouple from reality, but we have. And so this is what's going on, and people are grappling with this move from 12 on the VIX all the way to 65 in the span of very, very little, a little bit of time. What's it been? Maybe a week. And so this is a concern. Well, it started maybe around July 24th, 25th. And the sign was this curve started to flatten, which is your first sign that something's going on here. This roll yield, which I'll explain in another video, is now inverse. So most of the time, let's say 80+% of the time, this curve is in a nice shape, upward sloping contango, as we call it. And the contango is not a dance. It is the shape of a futures curve. It exists in many, many kinds of futures markets. And it tells you that things are generally okay. That's how things should be shaped. This is a shape that is telling you that something is very, very wrong. So we'll have to see. We'll have to wait and see what happens tomorrow. Futures are up tonight right now, just slightly. We've got a few little pops in the market. I would say that this is not done. I would say maybe 65 is going to be the high for VIX. We've gotten that out of the way. But I would not rule out a revisit to higher levels of VIX and a little bit of fear in markets. I think there's a couple other things at play here. I think there's a worry about... Sorry about that. I think there's a worry that AI may not be all it's cracked up to be. Perhaps people are spending on AI. We saw some good numbers from Palantir tonight. Look, I think the AI train is still going, but I think it's slowing. It's going, but slowing. And that's a concern for me. I have no doubt that NVIDIA's numbers are going to be terrific. Perhaps we rally into something like that. And after that, we have to reevaluate, because I think a lot of companies are investing heavily in AI and perhaps not getting the returns that they should be getting. And maybe not getting the return on investment. So I think it could almost be a Meta in 2022-ish, where they came out and Zuck finally said, okay, we're not going to go that crazy on the metaverse, because they were spending like drunken sailors on the metaverse. Maybe it's going to take for a company to come out and say, listen, you know what? We got enough GPUs. We got enough to last us a little while. There's been this almost hoarding mentality when it comes to artificial intelligence components. Maybe that wears off, and that's a problem for an NVIDIA. It's a problem for Microsoft. Those are really the generals of the theme. I think other companies like Meta actually do well. I think they are the king of ad spend. People, even in recession, I think people are just going to go to Meta. They're going to pull dollars from everywhere else. They're going to go to Meta. Nobody does it better than Meta. And a company like Amazon, also very, very powerful, able to monetize AI, right? When you're Meta, you're able to monetize AI. You're able to turn insight into dollars rather easily, because you're able to target people for ads and create new products that are really using that insight. Is some random company investing in GPUs and grasping at straws for AI? Are they going to really be able to move the needle on AI right away? I don't know. There's going to be a lot of that out there. So we have to remember that AI is this incredible thing. It's not going away. There's a lot of runway to it. But in the mid-90s and the late 90s, the internet was a big thing too. But a lot of companies crashed and burned, and that whole area really developed over time, as it were. So over the next 5-10 years. So let's keep that in mind. And understand where the risks are. I think the risks are still there, and the jury is still out on this particular picture of fear. Let's hope it sorts itself out tomorrow. If not, we could be in for more of this. So stay tuned, guys, and stay safe, and we'll talk to you soon.